Good evening, everybody. All right, tonight we're going to do a little quick uh, review of the spreads, why spreads are very effective, and then we'll go into our regular session. But we're going to be doing the 4-hour training. I guess it's 3 hours, but it's going to be 4, maybe even 5 by the time we get done with it on Saturday. So people wanted to every always everybody always asks for a little bit more information about how the spreads work. So let's take a little bit to go through that real quick, and then we'll get to the live charts. So the first question is, what is a spread? Basically, a spread is where you're entering and buying and selling the equal number of options of the same class of the same underlying security, but at different strike prices or expiration. Now, we're going to be just doing the simple ones. We're going to be doing them at the same or different strike prices at the same expiration. And when a spread's much more beneficial than just buying calls outright, and this is where the big, what do I say, the big misconception about options comes into play, that if a stock is going up, everybody says, oh, I want to buy the calls. Well, very rarely does buying the calls outright the best trading strategy. There's a lot of factors, and we're going to be going through those on Saturday, of why buying calls outright isn't the best option trading strategy. And this is why spreads are much more effective. Now, that doesn't necessarily mean not buying the calls or the puts outright is not worthwhile, but it's how you use them with the appropriate candlestick charts or candlestick patterns. And a bullish spread, when is a bullish spread most beneficial? When the upside potential of the move makes buying the calls alone too expensive for the target area. Or we can utilize spreads much more effectively because using the different parameters that we know that patterns create for us, we can pretty much calculate where our upside target might be and take much better advantage of doing a spread versus hoping that you're going to make lots of money with the calls outright. So there's 3 advantages that you have with a spread, and I'm just talking about the bullish spreads. We'll be going into the bearish or the put spreads, as well as selling a put spread, which is bullish, or selling a call spread, which is bearish. But just to keep this simple tonight, buying a spread has 3 major advantages. One, you've got less market exposed or less money exposed to the market. The percent return is greatly enhanced, and you have a much lower target for the price to have that greater enhancement of percentage return, and then your break even is much lower. So the important factor that we build into our candlestick chart analysis and applying option strategies to it is very simple. The math. What makes the most sense as far as the math is concerned? There's other places where you might use a spread. And that is, let's say you've had a very good call, a bull calls going great guns. Now you're getting up toward a toppy area, but there's still upside potential. You might roll out of your calls, take the profits, and then if there's more upside, you put on a spread, which means you have much less money exposed. And if it still continues higher in that higher risk area, your yeah, you got less money exposed, and if it continues higher, you're still going to make a very good percentage return. So now there's a couple of disadvantages to spreads. Obviously, if the stock price skyrockets and you thought it was going to go up from 50 to 57 over the near term, and you just bought a spread, well, your maximum profit, let's say on a 50 to 55 spread, is going to be $5, the difference between the two. But let's say the stock skyrockets to 90 for whatever reason. Well, you're going to miss out on that big profitability. But here's the question. What are the probabilities of a trade skyrocketing? And I can give you the answer to that with 40 some odd years of investment experience. The odds of ever being in a big, huge move are minuscule. Now, I'll kind of make a caveat to that, saying the odds of being in a big price move based upon candlestick signals is greatly enhanced by being or likely being in a big price move. But if you play the percentages, and you can create a very simple strategy that if you think it's going to be a big, huge move, you use a combination of buying the calls and buying spreads. And then a disadvantage of a spread is if the stock price moves inordinately fast after you put the spread on, and I'm just going to use the example that we're going to get to, that if you paid $2 for a spread that could maximize out to $5 at expiration date, then all of a sudden the stock skyrockets, you might be sitting with that spread for a week or two at a loss, even though it's moved up in price, because the different movement of each side of that spread may have kept that price at $1.80 or $2. It doesn't go up until you get closer to the expiration date. So here's the advantage, the leverage that you get from a spread. And I use this example that if a stock is trading at 50 and you think it could go to 55, and you bought, in this case, back in December, 50 calls, which were trading at $2.50, and it does go to your target of 55, well, your 250 now goes to $5, or you've made 100% gain. And if the stock was trading at 50 when you put the 250 calls on, that stock would have to go to $2 or 52.50 just to break even. Now, if you thought it was going to 55 or greater, and you decided to buy the spread, which meant you were buying the December 50 calls for $2.50, and you were selling the 55 calls for $1, the net out of pocket was $1.50. Now, if the price goes to your target of $55, instead of making $2.50, now you've made $3.50. So instead of 100% gain, you're at a 233% gain. And the price of that spread, or the price of that stock, only had to go to 51.50 to break even. So that's kind of the advantage. You have less money exposed. So if I'm looking at something like this, where you can see that Amazon bounced off the 50, it was trading at around, let's see, 1700, and it could go to 1730 up here at the 200-day moving average. Now, if we bought at the time, the which ones? I must have skipped something here. Hold on for a second. Do I have it in here? Must have. All right. So if you're buying the March 1700s for $9.30 right here, and it goes to this level, well, that means your $9.30 could go to $30. All right, a reasonable profit. Do I have it here? Yes. So you're going to make a 222% profit. Or at the time, you could have bought a spread for the 1700s and sell the 1710s for $1.80, which meant instead of it having to go to 1730, all that price had to do was go to 1710, and your spread price would have gone from $1.80 to $10, or 455% profit, and it didn't have to go to the 730. So if you do it backwards, to get the same return by buying the calls outright, for this just having to go to 1710, to make the same return by buying the calls outright, it would have had to gone to 1751. Which delta is preferable to select price? AQ, the one thing that you don't have to worry about as far as trading candlestick charts is the delta, the gamma, the Greeks. Because, here's that chart that it would, for instead of the spread having to go right there to make good money, the same return would have had to have been made by buying the calls outright, would have had to gone up here. So when we're buying a candlestick chart, just looking at a chart like this, what would you think your delta was? It wasn't very much. So it had nothing to do with what we expected the next price move to do. So that's exactly why we can come up with very high profit strategies, because if we know what to expect, let's say coming out of a fry pan bottom breakout is a good strong price move. The Greeks have nothing to do, these Greek numbers right here have nothing to do with what this price move is going to be from here. So we don't even pay attention to the Greeks. We're more interested in what the potential price move is. So if we've got trade setups like this, we've got different high profit strategies, like buying the calls right here. And if we see it's continuing, maybe you buy a put spread up here. I'm sorry, a call spread up here, where you might be paying 65 cents, that if it goes up through this level, your 65 cents now turns into $5. So you get much stronger leverage by owning these calls and putting on a spread. How do you know how far from the call price to put on the sell price? John, that's what you do with the calculation of the math. So if I see something like this, if I know wave 1 and wave 3 are going to be approximately the same, I don't know if this is correlated. All you have to do is on a lot of chart or a lot of trading platforms, I use Thinkorswim, because I can just put in the numbers right here, and this tells me if I'm buying the 81s and selling the 83.5 for 91 cents. It tells me what my price is, and I can pretty much calculate that if I've got 91 cents in and it goes to 250, I've got a very good rate of return. Or maybe I go out a little bit further. This is where you figure your own risk reward factor. Maybe I think this stock's going to go to 87 over the next 2 weeks. Well, maybe I buy the 83s. That's pretty far up the ladder, and sell the 85s for 27 cents. Now, if that continues, that 27 cents turns to $2. That's a good sized profit. So this is the type of thing that a lot of people don't calculate, and it's not that difficult. This is just saying, like right now in Apple, we bought the calls yesterday with the idea that over the next couple of weeks, or between now and next Friday, it could get up pretty close to the 238 because of the fry pan bottom. So buying the calls right here, because that was kind of calculating that if they broke out through the 50, which they did, that we have a fry pan bottom breakout. So what's our next strategy? Well, if this is our target, maybe we do a spread up here. And we can go up the ladder. We can start looking and saying, all right, maybe we buy the 130s. I think, where'd Apple close today? At about 130 and some change. Maybe we buy the 130 and sell the 135. We're looking at them right now, CB. That if this one expires next Friday, not tomorrow. So, and the stock's trading at 130, and could it conceivably get up to 135 right in here? Yeah, viable target. So maybe I buy the 130 and sell the 135 for $1.59. If it goes up to this level, or past 135, this 159 turns into $5. And where would the stock have to go for that spread to break even? It's got on expiration day, and next Friday, it's got to be above 131.59 to get our break even price. So again, this goes back to our upside leverage is much greater, less money exposed, and our break even is much lower. If I was going to buy the 130s, calls outright, to make the same percent profit of if it goes to 135 on the spread, I might have to go to 142 or 143 to make that same percentage return. So if I buy the 130, sell the 135s for $1.59, that's close, meaning it's close to the price. Maybe I go up the ladder a bit and say I want to buy the 132.50s and sell the 137.50s for 78 cents. Now if it gets up to that first target up here, now your 78 cents goes to $5. That has to be held to expiration to get returns, or close to it, yes. Now that doesn't necessarily, yeah, so the maximum spread between a 130 and 135 is on expiration date. Because if the stock is trading at 136, what would be the value of the 130s on that day? They would be at 6, right? The 130 plus the $6 for the option. And there wouldn't be any time premium left because there's no time left. What would be the value of a 135? Well, it would be $1. The 135 plus $1 makes it 136. So if you close that trade, what's going to happen? You're going to buy or sell the 130s for $6. You're going to have to buy back the 135s for $1, so it's still a net of $5. Now, there's other strategies too. Let's say it moves up to this level and you've still got 3 days left of trading, and let's say the options at that time are worth $4.65, or the spread's worth $4.00. Now you've got to evaluate what's the chart doing, and is it worth holding on for another 3 or 4 trading days to get another 35 cents, or do you take profits then and move on to something else? So these are all things that you can calculate by the math based upon how much time you have left. Okay, whoops, let me go back. Missed a few questions up here. Do you use options on institutional stocks mostly? KQ, not necessarily institutions, but stocks that have good, let's say, volume and good open interest. Because what we're going to explain is if you're trying to do a spread on a stock that doesn't have a lot of volume or a lot of open interest, what's going to happen? Well, you might have some activity at the 130 price, but there's no activity at the 135. The traders aren't going to be able to match that trade. So what we go through is showing what do we look for as far as the setup for a spread. Obviously, you have to have good volume on both sides of the trade. What happens if we don't close the spread at expiration? Well, that means somebody's going to call the stock that you have sold those options. They're going to call and want that stock. So what do you have to do? You've got to call the stock that you own the options on so that you can supply them. So at expiration, either you're going to close out the trade or the brokerage firm is usually going to automatically cross that trade for you. So it's still going to be, still going to be the net of that trade. You're going to have to close it because somebody's calling the stock away from you from one side, and you've got to fill that with the stock that you bought the calls on. Will you be able to close that option on expiration date if it is right at 138? Yeah, there's always going to be a value. I mean, as soon as you buy that, the reason you're buying that trade is because there's a market price for that trade. So as it goes up and down, the value of that spread is going to go up or down. So you're always going to have, it's just like anything else. You're always going to have a price to buy it and a price to sell it. Will you be able to close the option on the expiration date if it's right at 138? Yes. Yes, because if we bought, now remember, if we bought in either case, but let's use round numbers. If we bought the 130s and we sold the 135s and the stock is trading at 138 at expiration and you close out the trade, what's the value of each side of that trade? Well, the 130s are going to be worth 8 and the 135s are going to be worth 3. So you're going to sell the 130s at 8 and you're going to buy back the 135s at 3, which is still a net of $5. That's another way to do it, Big Red, is you can pick out any price that you want to. Now, again, you don't want to be buying spreads too far out. I usually, if I'm buying something that looks good and I'm buying options that are 3 or 4 weeks out, I'm just going to buy the calls or puts depending on which way we're going. If it's 2 to 3 weeks out, I'm not going to go any further than that because of the problem of if that stock all of a sudden moves fast, you're going to be stuck for a couple of weeks with a trade that might not be profitable, even though the stock price is moving in the right direction. And then usually in the final week, when you don't have a lot of movement, that's when we do the credit spreads, which we'll be going into on Saturday. So again, bullish spread has 2 disadvantages: that you hit a stock that is skyrocketing. So you're going to be limited if you bought the 130s and sold the 135s and the stock went to 100 or 210. Well, your spread's still only going to be worth $5. But the number of times that happens is minuscule compared to the times you're going to have just a little moderate move. If the stock price moves inordinately fast before expiration, that your option price is going to, or your spread price might not move. So basically it boils down to, and this is what we're going to walk through on Saturday, you got less money exposed, to market risk. Your percent return is greatly enhanced, even at moving your the target prices will be much lower, and your break even will be much lower. That's what you calculate. That's Winnie. That's what your calculation is. Let's go back up here. Over the next, look what it's done in the last 5 trading days. Moved from here to here. Is it inconceivable for Apple to move from there to there in 5, 6 trading days? No, that's the calculation. And why would we kind of expect that price move? Because we're coming out of a fry pan bottom. What do we expect coming out of a fry pan bottom? A strong price move. So this is not saying, well, can the price move that much? This is analyzing what is the pattern that tells us what the price move could be. How far out should you be purchasing a spread? 1 month, 2 months? No, are no more than 2 weeks or 3 weeks. A spread doesn't mean anything that far out in the future because the option prices aren't going to have anything correlated with each other on any given day. You want to keep your spreads probably around 2 to 3 weeks maximum. Only we know through the bullish candlestick pattern, the option trade will generate huge profits. Call options on the contrary or cost lock. Yes, or like anything else, if you're trading options, yeah, that's the risk reward factor. Is if we're calculating what the price move is likely to do based upon historic candlestick patterns and signals, that's why we're trading in the first place. Now, you can kind of offset that risk by doing a spread, again, because you got less money exposed and because you've got two prices. So there's a good possibility, and this is where we go into another strategy, which would be if we think it's only going to go up here, let's say to fill that gap over the next week, maybe you sell a put spread, which we're getting too far into the weeds here, but you sell a put spread, which means not only does it not have to go up here, it just have to maybe stay above this level to make a decent profit by selling that put spread. Which selling a put spread is a bullish move. You're expecting it to go up, may not go up higher. Maybe you get much better return or a much safer return by selling a put spread. That's another strategy. And again, all these strategies are very simple. I get a lot of people saying, well, I don't understand the spreads. They're too complicated. They aren't complicated. You can learn them in 3 minutes of what to do. So far, I've not been able to maximize the profit of a debit spread as I don't want to wait till the actual, you don't have to, yeah, you don't have to maximize your profit. You still would probably get better leverage if I bought the 130s and sold the 135s for what did I just say, $1.59. Let's say it moved up here and it looked a little bit soggy up here, and it wasn't quite to the 135, but it has now gone from 159 to let's say $3.90, still not near our $5. So you're still making the same evaluation. Is it time to sell that trade if things are rolling over, even though it hasn't gotten to our targets? So you're not you're buying the spread on the calculation of where it could move, and you maximize your profit at $5. But the true evaluation is this is where we think it could go, but if it starts rolling over, you do what the charts tell you to do. If it's time to sell, you close out the spread at that time. Henry, I've discovered that if you probably don't have, oh boy, probably 700 to 1,000 open interest, and then you have to see how much volume. And we're going to go through this all this on Saturday. That if your open interest is 840 on the 130s, and it's only 110 on the 135s, remember the trade has to be completed by having enough volume on both sides that there's trades going on at those sides. If the 130s have a lot of activity and there's no activity at the 135s, you can't make that trade. You can't be buying one and selling at the same time because there might not be any trading going on in the 135s at that time. So spreads work a lot better with the big volume stocks because you've got the big volume open interest and trading. I trade penny option stocks only. Well, then that's your trading universe. Um, how much minimum volume and open interest? Again, I look at it on the basis of first of all, you can pretty much tell that if the stock is only trading 400,000 shares a day, more than likely your open interest and your volume on the options aren't going to be all that great, which means if they're not that great, you're going to have trouble putting on a spread. So the steps we go through, and this is what we'll walk through step by step this weekend, is if the trade looks good, the first analysis is, what does the chart tell us? Looks like a good trade. Let's see about buying calls, and let's see about putting on a spread. Well, if we see that the volume in the options aren't big enough to put on a spread, or the options aren't big enough, or the volume isn't big enough just even to buy the calls, we're in the business to make money. And if we can't make money by the setup of that trade setup, then you have to pass it up, either just buy the stock or go on to another trade. And when I say go on to another trade, remember there's 9,500 trading entities out there. There's always going to be another good trade opportunity someplace else. Yes, this is being recorded. Yes, that's Jim. So part of the knowledge that's going to be expounded on Saturday is not necessarily just straight advice. It's because you don't want to do the same things. And so I did a spread last summer, and I can't remember what it was. And the stock kept going up. The stock kept going up, but my spread hardly went up in price at all. And even almost to expiration day, where it should have been priced at $5, it was still at $3.80 because there wasn't enough volume on each side to get it done. So I had to let it go right to expiration, and then have the brokerage firm call the one side and supply the other side for a $5 difference. But that's a much bigger hassle because now you have to go collect the stock and then sell it out. You like to be able to close it out whenever you want to. So I sat in that trade even though it was profitable, but I couldn't take my profits and move on to something else. I had to wait for expiration to close out the trade. You run into margin issues with most brokers if the underlying isn't above the short strike. You run into margin issues with most brokers if the underlying isn't above the short strike. Mark, I don't know. You shouldn't run into any margin problems because you're always going to you're not going to be called. It's not going to be called away from you if it's below the price. Nobody's going to make you give them the stock at if it's trading at uh, uh, can't think of how to say it, but you're not going to be if you don't have any margin because you've got a spread on, so you're protected on both sides. You get exercise if it's in the money, yes, but you're going to exercise yours because yours is in the money also. Winnie, I think it's right up until closing, and I think you can even trade it Saturday. Um, I think I've had to close out some trades on Saturday that were in the money. How much spread difference cost allow between bid and ask? You don't have to worry about that. That is the price. There is no bid and ask. That is what one side they can buy it for, and the other side they can sell it for. And they're saying that's the difference. So that's the net. So it doesn't matter. That's already calculated into the price that they're quoting you. Will you be discussing more complex spreads? No, I won't. I don't want to be spending my time at night trying to figure out a complex trade, just like I don't want to be figuring out which or spending all night analyzing which trades to be going after the next day. That's all simplified by the candlestick scans. And if I find a good trade the next day, I don't want to be spending all night trying to figure out whether I'm going to do a iron condor or a butterfly or any of that. I just want to know what am I going to put on to make my trade with sensible trading strategies, which boils down to buying calls, buying puts, buying call spreads, buying put spreads, or a combination of those two. That's about as complex as it gets. Saturday class is $4.97 for non-members. So here is the tricky part of our marketing, that you're better off joining as a member for $97 for a month, paying the $297, so you're saving $100, and you get 30 days of seeing what goes on in the chat rooms each day, the stock picks, the special training sessions we do during the week. Members get the Monday night session that is just like this session, except more oriented toward the positions that we've established. So you're much better off joining for a month, getting the discount price, the members price, and then seeing what you're seeing what we go through as far as the chat room during the day gives you a lots of good ideas because we got many people in there looking for the same type of chart patterns and signals, and where you can ask questions of whether this stock chart looks good or is that a signal, and other things like what's the best place for or the best scanning software, getting opinions from everybody, or what's the best trading platform. Is this the material you will go over this Saturday? This is part of it. This is just the spreads part. I was just taking a bit because this is the one that most people ask about, Jace. And then if this is something, when you're coming up for the private training, if you want to go in more into this, that's what we can kind of build into the training. Kenton, it doesn't matter. The bid and ask price on options doesn't mean a hill of beans right now, because I don't want to get on my soapbox. Yeah, this will be more covered this weekend. Much more detail. This is just kind of a example of how you use it, or at least use spreads. But Kenton, if you should have seen, obviously, that when all these brokerage firms came out that they aren't going to charge commissions, well, what happens is the bid and ask spread widens. So if you're looking at a bid of $2 on an option and $2.60 ask on an option, probably the market's at $2.30 or somewhere close to that. But all that means is if you desperately need to sell your options real quick, you're going to get $2.05 for them from your brokerage firm. Well, they're going to put it back out, or they've already got it sold at $2.30. So your commission was free, but your price was bad, and they just made a good chunk of money on that trade. Oh, Winnie, it doesn't really matter. Just the fact that you can see this is a big fry pan bottom, and notice how the uptrend started with your kind of your best friend. So, yeah, it doesn't matter where it started. What we're more interested in is what is it doing now. Okay. Is it better to purchase spreads on higher price stocks? It doesn't really matter. It all depends on the activity in the stock. People have different interests. Some people trade options on any price. Some people want to keep the option, trade options on stocks over 100 or have over 150 or over 30. It's up to each individual. Mark, yes. If I was going to do way out of the money option, my time frame would go from maybe 2 weeks to 3 weeks. If it was further than that, there's no sense doing a spread. You're probably better off just buying the calls outright. Mark, and that's another calculation that you can make is how far out you want to go. All right. I heard call spread on Bidoo expire 4/16. Please, your thoughts. I paid. Jace will have to go to those on live. Stop loss. No. Stop loss is no stop. Yeah, no stop loss. The reason you're buying the calls is because the underlying stock is moving in the direction that you expect it. So you're not buying the stock, you're buying an option, which is a that says you control that stock. You're not buying the option because of the option price, you're buying the option because of the stock price. So your stop loss is if it's time to sell that stock, then it's time to sell the option. Is it better to buy or to sell a spread? Ken, that's what we're going to be going through this weekend. Which type of price move setups is it better to, instead of buying a call spread that still has to go up, but if you think the upward move is starting to slow down, but it's still heading in an upward direction, then maybe you sell a put spread versus buying a call spread. Those are the calculations we'll go through this weekend. So a lot of people will ask, well, what's strike price and how far out? That is what we'll go through also based upon what does the chart tell us the price move of the underlying stock is likely to do. I can only afford $40 or less. Do you mostly trade more expensive? Lee, I don't understand that question. can only afford $40 or less. I don't understand what you're asking there. Becky, do we have the member sign up price link? If Edward, if not, Becky will try to get it. If not, you should be getting the member sign up link in your morning or afternoon comments. Victor, again, in the morning and afternoon comments, or Becky will get it here for you. I'll get it before we get too far. Let's see. I took the options training a couple of years ago with MSB. Okay. Yeah, that's another thing too, is if you took it in the past and paid for it back then, you come back for free for a refresher. I mean, if I join the group, you are only going to have less expensive stocks that you discuss. Lee, I'm still not figuring out what you're saying. I mean, if I join the group, are you only going to have expensive stocks that you discuss? No, we're not discussing stocks. We're discussing the methods to buying whatever stock you're looking at, and what would be what the patterns. So I buy calls on $10 stocks, and I buy calls on $400 stocks. It doesn't matter the price or the price of the stock. We're looking at what is the potential price move. How do you decide whether to use a debit spread or a credit spread? Credit spreads, real quick, if it's usually it's a very short-term trade. Like if I was going to look at a credit spread on Apple for expiration next Friday, I don't have to have it move very much for a credit spread, and that's what we'll go through again. Remember the one term I pointed out to up here, if I can find it. I can't find it, but the term was the math. There it is. What is the math? What trade makes the most sense math-wise? Oh, here may be the links. That's the link for the non-members. This is the link. I don't know whether I can copy and paste that or not. I'll try to track down the link before too long here. Okay. If you sign up as a member, is this for a year or a month to month? You can sign up month to month. You can sign up for quarterly, which is cheaper. You can sign up for semi-annual or annual. It gets cheaper the longer you do it. Morning and afternoon comments show only regular price. Okay, there, Becky just did the, I see her. Thank you, Becky. Okay. Yeah, the options, or during the day, we're looking at all prices of stocks. Some of them are identifying pattern setups in something like Apple, $130, or Amazon, $400, or trying to think of one, maybe OCGN. Oh, I don't know whether that has options. Or ZYES, trading at around $10. Maybe you buy those options. So the options is a trading that was the 2-day boot camp, was it? Oops, is that the, all right, we'll make sure we get the right link here. All right, let me, Becky, is that the right link for the options, or is that the different prices for the memberships? Okay. All right, let's move on to, oops, that was the 2-day boot camp. I'm sorry, that's me. I goofed up. All right, members will track down the right sign up for membership. Get that out to everybody. It should be in the morning comments. Abe said he put it in the morning comments. Let me make sure this one is centered. I can see that we need to move it a slight bit this way. When will you be doing another stock boot camp? Probably late in the fall, I'm guessing. If you missed this one, you could still pay for it and get the recording. The only difference is obviously you can't ask questions while you're watching it, but you can still ask questions in the chat rooms, or at worst case, you can email me with your question. Tonight is being recorded, Doug. Yeah, but we'll have lots of different trainings. As a matter of fact, we will be doing a private training session. Okay, is that the one? Becky, go ahead and I guess put that one in. Okay. As we saw, the market has acted pretty steadily. You can see that the Dow continues to trade up above the T-line, but the most forceful index right now is the NASDAQ. Ever since our best friend signal down here, we've had a gap up, consolidation. There's your double doji consolidation. Told us a lot today that the fact that they opened positive after the two dojis told us there was more upside. All right, try that link, everybody. Oh, I forgot to finish what I was telling you. We will, the private training session is, we usually have 4 or 5 people. It's a 2-day full training, but it's for somebody that's much more acclimated that they want to be trading to make a living at it or a second income. And it's basically the 2-day training, except we go much more in depth of if you're having a problem or having a mental hang up with your investing. As we're going through the process, let's say somebody says, oh, I just don't know when to take profits, then that's kind of built into the training session. And it's the type of thing where you don't, at the end of the session or each day, I mean, we go to breakfast together, we go to lunch together, we go to dinner together, and you can't get rid of me until everybody packs off on Monday afternoon and heads back home. So it's the type of thing that it's constant talk on investing. And if you do have a hang up or a problem, I mean, this is where you sort it out. So not only will you get very good clarity, I've had people come to this session, do a private training session that went on to teach other people how to trade candlesticks. One of my first training students was Rick Sadler, who now runs hit and run uh, candlesticks. And there was been at least two other people that set up their own little trading rooms using it. So this is where you're going to get very in-depth, very deep, in-depth uh, kind of filtering your own problems and kind of really getting a grasp on the logic of candlestick analysis. John, if you're interested, you just email me, steve@candlestickforum.com with your phone number, and I'll get on the phone and we'll go through all the benefits of one of these sessions. Yep, Doug's been to two of them. So I tell people this isn't something I try to force on people. It's something that you want to do to kind of go, not trying to learn stuff as you're going along. This is where you get a full grasp. If the weekend is 4,900 R, that's for the 2.5 days, and you got 4 or 5 people watching the screens. And the reason we do 4 or 5 people is if you're sitting on your butt for 2.5 days, you kind of get brain fried every now and then. But if you have other people there, they're usually asking the same questions you'd be asking, so it keeps the learning process pretty active. After that, you get a free year of free to the membership to the website, and we've got approximately $5,000 worth of training videos on the site that once you take this session, all you have to do is email Abraham and say, I was at the training session. I'd like to have this video, all of it's for free. Lee, yes, Rick actually worked for me for a couple years. He has a different trading style, and he loved candlesticks. As a matter of fact, he was the one that brought the T-line to us. We are doing this in Pittsburgh, PA. So, unfortunately, we can't do it at Cuca Lake anymore because of the people that I usually rented the house from moved in, so they don't rent it out anymore. SH, if you went to the options class before, you just email Abraham, say I went to the options class before, I'd like to get back into this one. Yes, the T-line has been very effective, and about 6 weeks, I think, after Rick came down from Anchorage, Alaska, we sat in front of the screens for 2.5 days. About 6 weeks later, he'd call back and say, hey, take a look at the 8 exponential moving average. Works very effectively. And that's the nice thing about candlestick analysis. The most important factor is the signals. Anything else that you add to the chart becomes a confirming indicator. So if you put somebody says put the XYZ indicator on, if it works, keep it there. If it doesn't work, take it back off. This is the important factor. The class is May 15th, 16th, and Monday, half of Monday, the 17th of May. I guess that is when May 15th, 16th, and 17th is May. Bob, that is something, if you're in the chat room during the day, ask people that use the charts on Thinkorswim so try that. How many people will attend? I'll probably maximize it out at 5 people. Now, some people want to bring their spouse. I've got one group that's a father and 2 sons, and that's why I always advocate if your kids are wanting to learn investing, start them off with candlestick analysis because that's the common sense analysis that cuts through all the rhetoric of buy good quality companies with good management, blah, blah, blah. That's not what moves prices. I pay for all our meals. Uh, the accommodations are right there in the hotel. Our hotels here in Pittsburgh aren't all that expensive. So you might be looking at $80 or $90 a night. But I take care of all the meals. We eat well, but we go to meals together. That way, whatever conversations we're having about investing continues right up or right along. Okay, so with this uptrend, we're starting to see some of the sectors that were acting well before. Blink, look at Blink doing a bobble breakout today. Steak and lobster dinners, Will, not far from that. As I say, we eat very well. We had a lot of seafood dinners when we were up at Cuca Lake. So here's the difference. We've gotten a good chart on Piedmont. You can see the kicker type signal off the 50-day moving average. Now, that's relevant. There's other stocks that were up today, like Pola, but what type of roadkill? That's right. What type of signal did it have? I can't see the left screen. Whoops, there. Let me move this over. I can't see the screen myself. Is that got it on? Can you see the symbol? Not yet. Are we getting closer? Well, pshaw. Let me. All right, now. Oh, how about that? Still out? A wee little bit more. All right. How about that? Okay. Okay. Let's do this. So Pola, observe the obvious. The obvious is this is not a reversal signal. This is just an update. What stocks do we want to go after? We want to go after stocks that we know have a signal that we recognize or the Japanese rice traders tell us is going to have a high probability result. Our best friend signal on Suave went into consolidation. And if we make this smaller, look where the consolidation, was. Well, suspects. Right about the same level it topped out before, but now what do we got going on? Best friend signal, consolidation, J-hook pattern setup. Our RFP, your bearish or your bullish left-right combo, gap up, your scoop type pattern. And here is something that you want to keep in your visual analysis. Notice where the price moved on RFP today. Right smack dab to the T-line. Now, why is that relevant? Because nobody has the T-line on their charts. So it's not like, say nobody, the statistical numbers make it zero, that out of the billions of people that are trading the markets, Nobody has the T line. The fact that they move right back to that level and bounce gives you good, clear illustration that this is a natural support and resistance level of human nature. We happen to use it as our an additional confirmation that the uptrend remains in progress. Twitter, look at your Morningstar signal right off the 50 and the T line and the 34. Stochastic still coming up. Tells us if they break through this level, more than likely they could go to this level, or simplified, we're in a strong uptrend. And BBL, one of the steel mining related stocks, keeps nudging right here at the 50 with kind of a bobble breakout potential. Notice the kicker type signal that took you right back up to the 50. If this breaks out, where's our next logical target? Up here to fill the gap. Why do we watch to see what happens here? Because we know what the results are of a bobble breakout. It implies that wave 1, wave 2, wave 3 of a J-hook pattern is in progress. We can just see much more are you sure it closed up there, or is that just where the ask price is? The bid ask gets very wide. Let me take a gander here real quick. Now it's still trading right around, yeah, it's bidding 59.77 and they're asking 66.10. That's just the aftermarket bid and ask. On Blink, it is better to buy calls or spreads. That's up to each individual. That's where you look at the math to see whether you might want to buy the calls or both, buying the calls and maybe a 50-55 spread. Nuance was another bobble breakout potential. However, when it opened up today and traded higher, it came and backed off. But what's our pattern? It's telling us we have a bobble breakout. So what's our strategy at this point? This is what is a great benefit of candlestick analysis. We know what this pattern should be telling us it should be doing. It should be moving in this direction. If it opens lower and trades lower tomorrow, what do? If you bought, you close it out because it's supposed to be doing this. If it comes back down through there, what's the obvious? The 50-day moving average is still acting as resistance. No. The fact that you're just about ready to break out, where do most breakouts occur? On a pattern or a breakout level? Usually up in the overbought area. Where are the buy signals? Where do the signals, where do you want them to occur? You want them to occur in the oversold area. So the signals occur in the oversold area. A pattern breakout is likely to occur when you're already in the overbought area. When you say buy the calls and then a spread as well, do you buy the spread higher up the strike from your calls? Yeah, that's one strategy we're going to go through. Right now, we bought the Apple calls. Now it seems to be working. So what is the strategy on this? Bought the calls, they're already profitable. Now maybe I buy a, what did I say, a 32.50, 37.50 for, what was it, 78 cents? Because if it comes up here, if I buy that for 78 cents and it comes up here and starts rolling over, and say, no, we should close out everything. Well, I've probably got a good profit in my calls, and whatever loss I might take, if I bought these for 78 cents and got back out at 38 cents, the 40 cents that I lost here was probably well made up for the profits in the calls outright. So it's just creating strategy that if you see a pattern that's working, now you can start enhancing it by knowing what that price move should do. Yeah, so we'll probably look at some option spreads on Apple tomorrow in the options room. Okay, and let's see. STLD, we closed out some of the calls because it was trading in the wrong direction. Now, that doesn't stop us now from buying back calls if it opens positive tomorrow, because what's it tell us? It tells us the T-line's still acting as support, or uptrend is still in progress. So that's the benefit also of candlestick analysis, or successful trading with candlestick analysis, is the being able to analyze when to be out of a trade and when to get back into a trade. David, hold on to your individual ones until I tell Rick to do the double line. I'll get to everything. All right, and here is a inverted hammer, bullish confirmation. And what did it do today? It came back down to the T line. What's the assumption? Remember what our probabilities are with a with an inverted hammer. The probabilities are pretty strong that we're heading up. Do you ever buy straight calls or puts rather than spreads? Yes. Again, depending on how far out we're anticipating this price move. KQ, yes, you could do that. Again, different strategies and all relatively simple. It's the math that makes the most sense. So Jake, yes, I buy calls all the time, and then I augment them by spreads, or sometimes if a price has moved up pretty drastically. Darn, which one did I just do? That's just great. You can't even think of what you did 2 minutes ago. Let's say hypothetically, which I did, I took profits on these calls. Now I'm up in the overbought area and a much higher risk, and it could go higher. So how do I modify my risk? Well, my new position might be buying a 140, selling a 145. That if it still moves up in a higher risk area, I'm still making good money with not as much money exposed in that area. Okay. So this is an important signal. Remember our statistics, that if you see an inverted hammer and they trade positive the next day, you've got a 95% probability or greater it's going to go higher. Look at your inverted hammer. Bullish confirmation. That is a very strong signal setup. And GRWG, look where it's nudging. Right now you could draw a line right down through this level. What's this tell us about this J-hook type pattern that bounced up off the T-line? If it opens positive, what's it telling you about this level? Not acting as resistance, look for wave 3. So this is nothing more than just 2 plus 2, analyzing when there's going to be a change of investor sentiment. And same scenario on using the T-line. What is the trend of ARCT? We re-recommended shorting this one. There was our buy. There was a place to cover. But then what happened at the T line? It failed again. Where is it likely to move? We don't know. It's still in a downtrend. What are the 3 moving averages? So I am sorry for new folks. Let's get rid of that. The blue line is your 50-day simple moving average. Your red line is the 200-day simple moving average. The reason these are on the charts is not because we're using them to make decisions. We're seeing what everybody else's decisions are at those levels. The gray line is the 34 EMA, which works reasonably well. And then the black line is your T line. You could take everything else off this chart and just trade the signals and the T line, and you'd be very successful. Anything else that can enhance analyzing what's happening at specific levels, you use. If it's something you put on your chart and it doesn't seem to really help any, take it off. Keep your chart as simple, because what's the most important factor on these charts? The signals themselves. Remember, the Japanese rice traders did not become wealthy using candlestick signals. They became legendarily wealthy. Is the T line the 8 exponential moving average? And then we got the 3 T line, which is the 3 exponential moving average, which kind of enhances the T line. Whoops. So there's your bearish belt hold signal. That's why we recommended going short on this one, because that told you they've taken the wind out of the sails on this one. Now there's a difference between a bearish belt hold. Darn, I can't remember what the other one was. Was it ANTX? No, apparently not. I can't remember what it was. The difference between a belt hold. No. All it is just failure at the T line. This is a blue ice failure. If I go back far enough. Came down through the ice, came up. You can see how it failed. There's our doji failure. Couldn't get through the ice, drowned. They go to the bottom of the pond. That's a blue ice failure. What did I do? Was one that you showed. Yeah, ARCT. Yeah, that's not a blue ice failure. That's just a failure at the T line. Could you show the bearish belt hold? Oh, which one was it? NNOX. That's your bearish belt hold. Bearish belt hold is when they gap way out of the trading range and then come back into the trading range. That's the beginning of a blue ice failure, yes. Look at your evening star signal failure at the 50. Where's your next likely target? Down here. That's a good bearish chart. Okay, who took my pen? Well, this darn cat. Okay, so the other biggies, Amazon, now trying to push through at the 50. NVIDIA, gap through the 50. Look at your double doji setup here. That's a very, whoops. Here's your double doji, your bullish confirmation, your gap up through the 50. Now you did a shooting star today. Stochastics now in the overbought area. So where is the logical place to put a safety stop? At yesterday's close. Because logic says if it comes down through there, where's it likely coming back to? The T line. Okay, DJ, thank you. And Netflix, another good strong gap up through the T line, up through the 50. Kind of a double bottom right off the 200. You stay long, but right now with it being up in the overbought area, I'd put a safety stop right there because the logic says if it comes down through there, what's it tell us about this level? That's acting as a resistance level. Okay, so the gold stocks are acting well. There's another bobble breakout on Barrick's Gold. EXK setting up that if it goes through the 50 after this little gap up, at least you're probably coming back up to test this level, which puts you at least in a positive trade. Ellie, again, hang on to your individual ones until I tell Rick to do the double line. Then everybody can put in a request. JNUG, little kicker type signal up through the 50. All right, so yesterday we were commenting in the chat room that Kramer said that OCGN was a good company to buy. Well, you can see what happens when somebody recommends it when there's no change of investor sentiment. Didn't do much. I was telling a buddy of mine today that Kramer just came out and said this was a good buy. We bought it down here at 73 cents. We bought some more at the around the $3 level, and we sold out up here in the $17 range. So that's what the charts do for us. Inverted hammer, kind of. Yes, I wouldn't be a buyer of this yet until you get more confirmation. You got to remember with Kramer, he's got almost as big a following as I do, so he can move prices around. Futa, nice J-hook pattern. Now, if this is a J-hook pattern, wave 1, wave 3, what's it tell us about this level? They're about ready to break out. So you could buy this one on positive trading. Blink was good. Blink's got the bobble breakout. But Pola, just to give you an example, did not do a reversal signal. That's just an up day. You want to look for things in that sector that had signals. Look at your inverted hammer after a bullish engulfing on GOEV. Where's your first target? Fill in the gap. Was it Bear Stearns or Lehman Brothers? What's the difference between a bobble breakout and a cradle pattern? Oh, completely different. A bobble breakout is a J-hook pattern where you can see the actual resistance level. A cradle pattern is completely different. It's a series of dojis at the bottom of a trend. What is the signal on GOEV? The fact that you did a bullish engulfing, an inverted hammer, now bullish confirmation with stochastics coming up. Yeah, so you always have, this is why I tell people you never listen to an analyst. Because there's one simple rule on Wall Street. If something is working well, everybody knows about it. So the rhetorical question is, do you know who the best analyst is on Wall Street? Well, if you're all sitting there thinking, nah, I don't know, it's because there isn't any good analysts on Wall Street. If there was a good analyst on Wall Street, everybody would know about it. RCON started the J-hook pattern. Now you definitely need to see this open positive and trade positive tomorrow. So when you see things like this, whoops, it's hard to see, isn't it? When you see something like this, where you've had a big breakout, what's the first thing you want to do? You want to go back and see what news caused this. If this was an upgrade by an analyst, it's probably not going to be relevant. If this was something that they got approved or FDA gave them a good rating on a trial, that's something that's probably going to consider or cause or create more upside. Mike, yes, that's what you. That's why you don't listen to analysts. Um, Listen to what the chart says. I've seen so many times where I don't have anything, but you have a nice uptrend in a stock, and an analyst will come out and say it's time to downgrade this stock, and for 2 days it goes down. That's everybody that follows that analyst selling off their stock, and then it goes right back up and does what the market was telling you it was doing beforehand. Why don't you go on Wall Street and be a good technical analyst? I guess R for who? Oh, yeah, but how long has Kathy Wood? This is always something that I always tell people. An analyst might have their day in the sun for 12, 15 months, and then whatever their magic powers that happen to hit them right on some of their decisions seems to go away. CB, what did we say about holding on to your individual ones until Rick does a double line? Okay, so GKOS, there's a kicker signal. What's the first thing you want to do is go back and find out what that uh, uh, caused that room. Lee, in the regular room, we usually have somewhere around anywhere from 210 to 260, depending on what promos are going on. And then we've got another 30 or so over in the options room. Let's see. Sohu. That's kind of a cradle pattern. Have a big down move. There's your headboard. There's your bed. A bunch of blue feathers. A bunch of dojis moving sideways. And there's your footboard. That usually indicates that's going to be a strong price move from there. That's a cradle pattern. And ATNF. What happened? Oh no, something seriously wrong. ATNF. Oh, that's the one I was looking for. That's also a bearish belt hold. But notice what happened as it sold off. Now we saw that the T-line was acting as support. Now it started back up. So you can stay long on this one. Here's one of the transportation stocks. There's your piercing signal. There's your left-right combo. There's your doji sandwich. Figure that's in an uptrend. Orgo, just a nice steady eddy. I don't know why I have that on here. And FSM, there's your trend kicker signal. Remember, a kicker signal is one of your strongest signals. A trend kicker signal is just tells you there's more upside, and especially when they break through a resistance level, it tells you the resistance level is not there anymore. Notice what the reversal signal was on here. There's your big morning star signal followed by your doji sandwich or your McMuffin. Peloton, there's your fry pan bottom, supported on the 200. There's your little doji sandwich, and now where are you? Right back where the fry pan bottom started, and you're at the 50. So if it breaks out tomorrow, what's it telling you? One, the fry pan bottom is breaking out, and two, that the T-line or the 50-day moving average is not acting as a resistance anymore. So that just gives you a double confirmation that that fry pan bottom is breaking out. Nautilus, kind of the same scenario, kind of a double doji setup. Let's make this big enough where we can see it. Came up, consolidation, consolidation. Where's your next move? At least up here, then possibly back up to the 50. So again, this analysis is what we call 2 plus 2, where you just put everything in multiple analysis into play. There's your gap up. This is where you'd go back and find out what caused that move to the upside. Okay, so that's about all I got tonight. Are there any general questions on candlesticks? And hold on for a second. Okay, sorry about that. I had to freshen up the drink. Okay. Oh, which one was the cradle pattern? Sohu. Not very distinctive over here, but a cradle pattern is a downtrend with a big headboard. Then you go flat. Remember, if one doji means indecision, a series of dojis means greater indecision. And the result is usually a strong price move coming out the other side. So call it a cradle pattern because the cradle's kind of hanging down between the two trends. Do you discuss options in the Candlestick Forum membership? Yes. I mentioned what we're doing as far as options in the regular chat room, but then we discuss in much more detail over in the options room. So what we're trying to do, keeping the two rooms separate, is a lot of people don't understand all the terminology when it comes to options. So we didn't want to have that all in one room. Plus the people in the options room, they can discuss their different strategies, understanding each other much better. I see ranged bars don't form the same candlesticks, don't find dojis. I see ranged bars. Yeah, I don't know what ranged bars are. A doji sandwich is, yes, a continuation pattern. It usually implies there's going to be more upside. Now, a morning star signal is one of your 12 major signals. And if you have a morning star signal, it implies there's going to be upside. A doji sandwich is a big up move, which sometimes is the third part of the morning star, a doji, and then a doji sandwich. which is now a morning star followed by your doji sandwich, which is a morning sandwich, which is your McMuffin, which gives you double confirmation that the uptrend is starting. Okay. Was XL a kicker signal yesterday? It would have been had it, no, it wasn't a kicker signal. A kicker signal looks like this. This is a kicker signal. You're in a downtrend. It opens here, closes here. That's your dark candle. The next day, it opens at or above the previous day's open and goes the opposite direction. That tells you that the investor sentiment has been kicked in the opposite direction. That's your most powerful reversal, individual candlestick reversal signal. Now, this is called a trend kicker signal. Notice you're already in the trend. You have a down day. The next day, they gap it up and go the opposite direction. There's going to be more upside. That's Oracle. You can see where Oracle did a little Morningstar signal, kind of a doji sandwich. Still in an uptrend. How long do you stay long on this? As long as it stays above the T line. What is the stochastic below on the chart on Sohu? What is the stochastic below on the chart on Sohu? What is the stochastics below? Well, this is your stochastics coming up. But remember the most important facet of a candlestick chart is the signal itself. Lee, a lot of times, if I see a kicker signal in progress, we will buy it immediately. For example, not too long ago, see if I can make this big enough. This one was trading right here at $2.90. We started buying at $2.90 because it was doing a little kicker signal. We went back and did our rare research analysis, reverse engineering, and it said that they were approved with whatever their equipment was that helped blind people see again. Well, that looked like something that was probably going to cause more upside. Was it going to cause more upside like this, where it was up 585% during the day? Didn't know that. All we knew is that at that point, we could be buying because we had a kicker signal. And when we found out what the news was, it said, yeah, that likely will have more upside. So that was a long answer to say, yes, if I see something that is doing a kicker signal, I will buy it immediately. Today, I was buying PPL because it was doing a kicker signal above, off the 50, above the T line. That implied there was going to be more upside. Do you find that the T line is more dependable if it is rising 50 m? It's right above. No, we're not trading the moving averages. We're trading the signal. The T line crossing anything has nothing to do. All the T line is a natural support and resistance level of human nature. Again, I could take everything off this chart except for the signals and the T line and trade very successfully. Now, I say trading very successfully. When candlesticks first came along, I became a good trader. Now, that term is based on prior to the candlesticks coming along, I was the worst investor in the world, and I loved investing. And I was a stockbroker for 8 years, got out of the business because I realized brokerage firms had no more idea about what made prices go up or down than the man on the moon. Well, when candlesticks came along and somebody finally badgered me to look at it, which I resisted for 3 months because I figured anything as sophisticated sounding as candlesticks couldn't be anything worth looking at. But when I started looking at it, I kept thinking, this makes sense. And the more I studied candlesticks, the more sense. All it is common sense put into graphic depictions. Okay. With that, Rick, go ahead and do the double line. And in 3.6 seconds, do the next double line. UMC. Oh, okay. Somebody was asking again. Saturday, we start at 10 o'clock. We're supposed to quit at 1. If we get done before 2 or 3, we'll be lucky. And it's not the type of training sessions you say, all right, here it is. You learn it. We'll keep going through it until everybody understands how to use candlesticks in conjunction with candlestick signals successfully. I can sit there all day long. I just want to make sure people know how to use the options correctly. So we're going to start from the very basics, from the terminology used in options, what the options represent, and go right through the puts and calls and the combinations of puts and calls with bullish spreads, bearish spreads, debit spreads, credit spreads. They're all, and again, if this sounds confusing to everybody, it won't be. Everything I do is simple because I don't want to spend a lot of time at night trying to figure out what to do with my next trade. I want to be able to do it in a matter of minutes and have a very logical trading strategy. UMC, that's more of a bobble breakout. I wouldn't be afraid to be buying that one on positive trading tomorrow. And ears. Yeah, it's not great, but you could be buying this one on strength. Guild, that's a nothing chart. I'd be someplace else. No direction. Wouldn't be long or short this one right now. Edit. Kind of the same scenario. You're moving sideways. I'd be someplace else. When I say someplace else, there are just so many other good trade setups out there. If you've got one that's moving sideways and not really with any great direction, take those little green pieces of paper and move it out of that trade and move it to something that has much better prospects of those little green pieces of paper making more little green pieces of paper. Clove, find out what broke it out today and see if you go into a 45 degree. ATEC, that one you can be buying with the expectation you're going back up into this trading channel. Let me make this a little bit smaller. I would suspect you're going to come back up into this range. IZ started out nicely, but backed off. Whoops. Nope. It backed off for a while and then came back up. Let me make this bigger. This one I wouldn't be afraid to be buying on positive trading. Kind of your double doji sandwich. Mara is running out of steam. If you're long, you can stay long, but I probably wouldn't be long or short this one right now. And Vuzi, that one you stay long. Your piercing signal, your doji sandwich, now you're breaking out through this level, at least least watch to see what happens when it gets to the top of that range. This one did not have a signal. So here's what you always have to be aware of. This was a big up day, but it didn't have a reversal signal. It's not a kicker signal. Now you can expect more upside, but when you don't have a reversal signal, the first thing that I watch for is what happens when it gets to the first resistance level. And Pixie, you can buy this one, but it definitely needs to be opening positive tomorrow. KLR, for some reason, KLR does not come up over on this screen. I don't know why. It was an inverted hammer, but came back down below the T line. Let me do this real quick just to give you an analysis. KLR did an inverted hammer a few days ago, failed at the 50 with a bearish Harami, and back down below this level. No, I would not be holding this one. I would have closed it out yesterday when it closed below the T line. It's now not a good trade. So another advantage of candlestick analysis, shows you when to get in, and then there's times when it shows you to get back out of the trade. There's your bullish engulfing gap up. You stay long as it stays above the T line. You're getting up to the overbought area. I'd have a safety stop just below today's open. Whoops. Sorry, Bob. You were way ahead of me. Yes. Use today's open as your stop. Logic says if it comes down through there, the bears are back in control. Nothing wildly exciting here. You stay long. I'd put a safe. AMGN. This one, look at your bearish doji sandwich. You could be shorting this one. Where do you think your next target would be? Probably back down to the moving averages. AMAT should be acting better with the shortage of chips, but looks like it's trying to do a J-hook pattern. I would still use the T-line as your stop. Shopify, little gap up kicker. You can buy this one. Not a kicker. I can't tell what color that is, but a little gap up best friend. You can buy this one if it breaks out through the 50 tomorrow. And band, that's a J-hook pattern. Nothing wildly exciting, but you could be buying this one. I did not really have a strong uptrend. It did not really have none. Just using the J-hook pattern for the fast. And yeah, it's viable. You want to buy it on strength, you definitely want to see it break out through kind of that resistance level. Etsy, nothing wildly exciting here. It's moving up. It still has to break through this area. It's not a real good chart and it's moving sideways. So if you're buying it, it needs to break out through all this level. If I was buying on positive trading tomorrow, I wouldn't want to see it close back below the 50. F-SLY, nothing. Which way is this one going? Absolutely sideways. You can see kind of the wedge formation. I'd be someplace else. And Boeing, kind of the same scenario. Now, you do have a bullish engulfing. It's pulled back to the T-line. If you're long, it has to open positive and trade positive from here, and it needs to break this little downtrend. Let's see, we did square, right? Yeah, stay long. ATXI, not anything wild and great just yet, but it's moving in the right direction. So there's your McMuffin. Morning star signal followed by a doji sandwich. It didn't confirm. Well, now it's confirming because it came right back up through that level. I would buy this one on positive trading. Just watch to see what happens once it gets to the 200-day moving average. McCormick or McKesson, stay short. Williams Sonoma, you can stay long, but I'd put a safety stop just below today's open, because if it comes back down through there, what's it telling you about your trajectory? Kind of waning. SPQ is not, whoops, not a symbol, but SPG might be a symbol. That's a nothing chart. If I had been long, I would have closed it out today. It's not going anywhere. Bed Bath and Beyond, another kind of nothing chart. If you like this one, you could be buying it on positive trading. Just don't let it close back below the T line. A fry pan bottom? No, that's not really a fry pan bottom. That's really a nothing. Not any real great trend. So that's what you want to use candlestick analysis for, is tell you which way is a price moving. Lots of times they're just going to move sideways. Probably wouldn't be paying too much attention to this one. If you're long, you can stay long. I wouldn't want to see it close below the T line. Lockheed, stay long. You're in the overbought area, so where's your logical place to put a safety stop? At today's open, because if they come down through there, the sellers have gotten or taken control. Dollar Tree, there's your inverted or your shooting star Harami. I would have closed out the position here with the expectation it was coming back to test the T line. Then if it tested the T line and started trading back up, then you could buy it back. If you stayed long, you still use the T line as your stop. All right. Thank you, Mike. Let's see. Coals. You can stay long on this. Obviously, you need to get through this level. Right now, it's not doing anything real decisive, but you know that you're in an uptrend as long as you're above the T line. AAME inverted hammer. Let me take a gander here. It could be. Usually you want to see an inverted hammer at the bottom. That might just be a day where they took it up and failed. So even if it opened positive tomorrow, it would need to close positive and get up through the 50 to tell you that, yeah, this was the bottoming action. Oh, on the calls, because of the slow movement, that's something I'd probably be more apt to do a spread, where if this is a logical target over the next couple weeks, maybe buy a 60, sell a 65, or if they've got a 62.50, sell a 65. But because it's not moving with any great resiliency, I'd, I'd be more apt to have less money exposed using the spread setup. Now, kind of your consolidation bounce up, you can buy this if it comes up through the 50. Daku. Stay long on this one. AYTU. You got a Morningstar type signal. If you had been short, look at your kind of your bearish belt hold that failed or failed the uptrend. If you were short, I would have probably have covered the short today, because your probabilities are that if you're in the oversold area and you're seeing a Morningstar signal, that was time to start taking profits. I wouldn't go long though until you see it close above the T line. Oh, Jake. That's not a symbol. Or it's not working on this one. There's your inverted hammer, bullish left-right combo. Another one that if you were short, obviously they're starting to buy in the oversold area right here on the 50. If this opened positive tomorrow, I'd close out any short positions. I wouldn't be going long until it gets up above the T line. Oh, pshaw. Yeah, that's kind of your bobble breakout. You could buy this one on positive trading tomorrow. Zenga. GSM. Tom, I'll just ask you, which way do you think this one is going? Pretty much sideways, and nothing that's showing you any bullish control. I'd be someplace else. And Yale, if you're long, you can stay long. Obviously, you need to see it break out through this level. Use the T line again as your stop. Was possibly looking at a short on Sava, but it is a double bottom, also a doji today. And look where you are. You're already in the oversold area. So here's the type where if you're thinking of going short in the oversold area after it's moved this much, what should you be analyzing? You should be analyzing where should I have been shorting this one? Probably after a bearish Harami, a bearish left-right combo, and a lower open. That's where you should have been shorting. Or when it did a bearish left-right combo failure at the 50, that's where you should have been shorting. Now you should be looking at seeing whether it's time to start covering the short position. GGB, nothing to do here except stay long and watch to see what's happening right here. If I was long, I'd have a safety stop just below today's low. It shouldn't come back below that level. Blink, don't have a target, but if this is kind of a fry pan bottom, bobble breakout, I would suspect they could bring it back up at least to test the recent high. U.S. Steel should be out of this one. There was your evening star signal starting to show pullback. The worst case scenario was you waited to see if it was going to hold up at the T line. It didn't. That's where you would have closed out that position if you held on after that. The other steel stocks, Steel Dynamics did close slightly above the T line today after an indecisive pullback, which tells you could still be buying this one if it opens positive. If you're long and it opens lower, you close it out immediately tomorrow. XPEV, another rhetorical question. Which way do you think this one's going on that chart? Right now, it's going nowhere. I'd be someplace else. Best Buy, observe where you had the left-right combo. Right here, where you can see there's a resistance level. That would have told me that if it closed here today, if I was going to stay long, if I was long, it has to open positive and trade positive. If it opens lower, close it out. You can always get ready to buy it back if it comes up to that level again. Will Peloton break through the 50? We don't know. Likely it should because it's a fry pan bottom. So that's where you can easily get, it's a given economy is reopening. They are indoor workout related. It doesn't matter what the analysis is. Let the chart tell you what everybody else is thinking. OKTA, a kicker type signal. It's not really a kicker signal. You can see kind of though the rounding bottom. I would suspect at least coming up to test the 50. And POW, you stay long. ASO, oops, there was your bearish. Now here's the warning. When you got up into the overbought area, what's the most simple analysis the Japanese rice traders tell us? Where do most people buy? They buy exuberantly at the top. How do we know exuberance at the top? Because they're usually gapping it up. So if you see a gap up in the overbought condition and see a doji telling you there's indecision between the bulls and the bears, and they opened up positive the next day, where's your safety stop? Back at the open, because logic says if they're coming back down in this direction, that was your alert to tell you the profit taking is going to start. So who was asking about that one? I forget. Go back up. So RAM, that's just a very simple alert to tell you get ready to start taking profits. Right now, I don't know what to tell you. I hope if you're short, yeah, I probably, nothing on this one. Gents, at least it slows things down. Which direction is this moving? Right now up, but you can see there's kind of a trend channel here. So the first thing I would watch is to see what happens at that level. Let's see. You're Deborah, I would say you're trying to hope that it's going to do something. So you're looking at a chart where stochastics are going sideways, the stock price is going sideways, not any great strong buying. And even if it does come back up here to test the 50, you're looking at, I guess that might be a 10% move. But right now on that chart, that if I looked at that chart and said, would I be a buyer of this? The answer is no. There's nothing there right now. DraftKings, that is close to a blue ice failure, but it's giving you a bearish J hook prospect that if this starts trading lower, your first target is right here. If it breaks that, then you're heading down. Wave 1, wave 2, wave 3 could take you down to the 200. Oh, it's 10 o'clock. Way up past your bedtime. And AG, you could be buying this one. The gold stocks and the silver stocks seem to be working well. Wampum, you can see the trend kicker signal making the prospect of the 200 likely. Pause, another trend kicker trying to break out through this level. So they have some more upside. All right, a few more. Trade desk, nothing real strong here. If you're long, you can stay long. Just realize you've got a downtrend that probably correlates with watching to see what happens at the 34. Okay, with that, right now this market is still showing good strength. I would expect some profit taking in here, but we've had a couple of days of consolidation in the NASDAQ, and the Dow also isn't doing anything that would show you there's any exuberant buying going on. So with that, we'll see everybody in the chat rooms tomorrow. We'll see you then.